Hi, this is Ankur. In this easy to understand 30 minutes video, you will master personal finance. Interestingly, this topic is never taught in college or school. Imagine if someone is young and they exactly know what to do with their surplus money, it will be so easy for them to create wealth. My effort in creating this video will pay off well as far as you get the big picture right. So let's get started.
Where do you stand financially? No matter how much you know about investments, stock market, credit cards and insurance, if you do not know your money well, you are most likely to fail in planning financially. The most important aspect in financial planning is to know your money, that is your financial position well, and then be able to manage it wisely. So what makes up your financial position, also called net worth? Your assets and liabilities. Well, the amount of assets, that is items of value you hold, is a precise indicator of your current and future financial position. Assets tend to add to your income, that is in the form of investments, or they help reduce expenses, as in case of, let's say, owning a house. It saves you on taxes and paying rent. Thus, assets help to strengthen your financial position. On the other hand, liabilities weaken your financial position. Liabilities is something that you owe to someone else. For example, a home loan, a credit card outstanding. So the rule is more assets and lesser liabilities would always help you achieve better financial position and strengthen your money. So just like any disease is best treated when detected in an early stage, similarly with regard to your financial health, recognizing early signs can help you take right steps, prevent great disaster for yourself. Watch out if your liabilities, including credit card bills, are more than your assets. If that's the case, you should first bring down your liabilities to manageable level before you even start investing. Now let's open the Excel with the name net worth and do this for ourselves in terms of where do we stand today financially. Understand your cash flows. Simply speaking, it's the money that is coming in and money that is going out. Where does your money come from? Well, list down the sources of your income. That is, it could be a salary, rent, pension income, and so on. And the amount that comes in from each source each month. It is always a preferred option to look at after-tax income that will be available. Do you check your bank account at the end of the month and wonder where the money went? Before you can manage your money, you have to know where you are spending it. Get in the habit of recording your expenditures once a week. It's useful to separate your expenses into two categories. First is fixed needs. Well, these are necessary expenses that stay the same from month to month. For example, rent, phone bills, etc. Variable needs. Well, these are necessary expenses that may vary from month to month. For example, petrol expense, the amount that you are spending on food outside, and so on. Variable needs also include something called discretionary expense. As the name suggests, it's as per your discretion. So an example around this would be shopping. So it depends on you how much you want to spend for shopping in a particular month. So if you have a monthly saving goal, which you should, include it as an expense. For example, if you want to save X amount, that X amount should be part of your expense. You might be wondering why? Well, the purpose is it is much easier to save money if you have planned for it in your budget, and it's important too. So now open the Excel with the name cash flow and do this exercise for yourself where I've broken up your expenses into a variety of examples. You can just write down your monthly expense and your income and see where do you stand in terms of your cash flows. Goal-based financial planning. Just as daily tasks have allocated time slots, Similarly, you need to have a slot in your life to manage and grow your money. There are many ways to do this goal-based assessment, but one of the most intuitive ways is to bucket them. You start with the lowest bucket, that is need. These are goals that are extremely important to us and provide protection from anxiety. Next comes the want. These goals are not as important as needs. However, they ensure that we maintain a desired standard of living. And then comes the aspiration. These goals may not be necessities, but they help us achieve upward wealthy mobility and give us a certain status in our social circle. So just to give you a few examples around need, it could be retirement, planning for your child's education. In want, it could be buying a certain car for your family needs, or planning for your child's education to go abroad. Aspiration would be something that helps us achieve a certain status in social circle. For example, someone in their mid-40s thinking of setting up a startup, starting your own venture. That would be form of a aspiration. So every person is different, and so are these buckets. For example, for one person, let's say international vacation may be a want, but for the other person it could be an aspiration. This is precisely the reason there can't be any template to do this exercise, but rather only a broad-based structure, and you need to reflect on your personal needs, your personal requirements in terms of where each goal fills in. So now you have a basic sense of this categorization. Reflect on your life and write it down on a piece of paper. Then segregate across these three categories. Please note that at this stage, do not worry about investments. That is to be done later. Your behavior defines your asset allocation. When the market rises, people start investing, and when market falls, people start selling. Think about it. If you are in a shopping mall, would you buy stuff at a discount or on a full price? Therefore, if you manage your emotions, your investment portfolio is bound to do better. Open the Excel risk profiler and answer a few questions to know your risk profile. Based on the result, you could be conservative, moderate, or aggressive. Here is a simple asset allocation breakup. This way, you will be able to focus on the asset allocation and not what newspaper and other periodicals are feeding you. So now, what is growth and what is income? Growth assets are used to grow your wealth more than the inflation, but takes few years to reach that objective. Equity and real estate are growth assets. So equity and real estate will not grow on a daily basis, but over a long period of time, say 5 years or beyond in case of equity, and in real estate 10 years or beyond, they tend to grow more than the inflation in the economy. An income asset is to produce income. For example, a fixed deposit with a bank. An income asset is not expected to beat inflation. Other than fixed deposit with a bank, something like a provident fund, a PPF, will also qualify as income assets. The risk profile that we learned about earlier establishes a broad range between growth and income. Now you might be wondering, if you are planning for your long-term goal, say retirement, say you are a conservative investor, why not invest in only equity or real estate? The answer to this would be your behavior will not allow you to stick to your equity real estate allocation for long term. And in case the value falls, you may act in a way that would jeopardize long-term objective. So that is the reason Asset allocation is key and it should reflect on what kind of person you are in terms of looking at various forms of investments. A conservative investor would rather be more inclined toward income asset, whereas an aggressive investor may be more inclined towards growth assets. Let's explore our investment options and then we will fit these investment options into the wealth allocation framework. Growth assets. Real estate and equity are prominent options within the growth category. Real estate requires huge money to be invested in one go, and there are illiquidity issues. This does not mean real estate is not a good option, but rather suitable to investors who already have a decent corpus. Remember that your primary home is not your investment and should be excluded from the investment analysis. What about equity? Well, equity is a stock ownership in a company. An empirical study suggests that this asset class provides higher return if invested for long run. Remember, life insurance company LIC also invests in equity. Bonus amount in case of an insurance product would also depend upon how the underlying portfolio of equity has performed. So there are few simple options for equity investment. One is a direct route, which is you directly invest in company stock. Well, if you do not have the time to perform fundamental analysis, I would suggest you should stay away from this way of investing. Mutual funds are basically pool of assets, pool of money from numerous investors who wish to save or make money just like you. Investing in a mutual fund can be a lot easier than buying and selling individual stocks by yourself. Exchange traded funds or index funds. ETFs invest in stocks that comprise an index. The proportion in which it will allocate money may be the same as individual stocks weight in the index. For example, a Nifty ETF will invest in 50 stocks comprising the Nifty, most likely in accordance with the weight of individual stocks in the index. Since the selection and weight is decided by the index itself, there is no active manager to manage your investments. Hence, the management fees of ETFs are extremely low. I have not mentioned unit-linked insurance plans because that's not a good option to take equity exposure. And there are other options such as PMS, Portfolio Management Scheme, alternate investment funds. These are suitable for those clients who have more than 2 crores of investable surplus. So if you're a first-time investor, an index fund or ETF is a preferred way of investing or taking exposure on equity. Once you get more experience through index-based investing, you should invest in mutual funds. Income option. There are a variety of assets that are categorized as income assets. For example, public provident fund, national savings certificate, provident fund, fixed deposit, corporate bonds, government bonds, and debt mutual funds. Additionally, we have new pension scheme NPS that gives you the option to combine growth and income assets. Both income and growth assets have place and should be evaluated within the wealth allocation framework. Retirement planning. Well, retirement planning is about ensuring that there is adequate income to meet the expenses in the retirement stage of an individual's life cycle. There are few things you need to know before we get into the calculation. One is living expense. This comes from the cash flow analysis, and this includes both fixed and variable expense. The next item you need to know is when do you plan to retire, at what age, and the third is your life expectancy. So let's say you are 30 years of age and you decide to retire at 50, and based on your family history you think that your life expectancy is 80 years. how do you understand that what is the kind of retirement fund that you need, or retirement corpus as we call it, at an age of 50 when you retire? So that money will be sufficient to meet all your expenses within the range of 50 to 80 years when you're not really earning anything. So time period from 30 to 50 is also called earning life, because this is the time when you will be earning, and 50 to 80 is called the retirement period or retirement life. So let's say for example that you arrived at your current living expenses as 1.5 lakhs per month, or say 18 lakhs per year. Basis this, what is the kind of retirement corpus you need to have at an age of 50? So there are two ways to do this calculation. One is a simple way, the other is more complicated, or I would say financially oriented way. So let's talk about the simple way to calculate the amount of retirement fund. So it's simply current annual living expenses multiplied by retirement period. As you can see that our retirement period given the example is 30 years, that is 80 minus 50, and the retirement fund basis 18 lakhs of yearly expense will come out to be 5.4 crores. This is 18 lakhs multiplied by retirement period 30 years. So for those who do not want to get into the financial calculations a lot, this is a good ballpark number that you can focus on. So now let's bring in investment return and inflation into the calculation. Before we get into the calculation part, we need to understand three concepts: future value, present value, and payment. So let's take two examples. One is 10,000 rupees invested every year for the next 5 years, earning 10% per annum. What is the future value? That is, at the end of 5 years, what is the value of that money? And the second question is 10,000 rupees invested every year for the next 5 years at earning 10% per annum. What is the present value today of that money being invested? We understood in time value of money that future value is equal to present value multiplied by 1 plus investment return, or R, raised to the power n. So when we see these numbers, what we really need to know is apply this formula of future value on each of these data points. That is principal, present value, multiplied by 1 plus R, which is 10%, raised to, so this money is invested for 5 years. Similarly, in the second year, this money gets invested in for 4 years. In the third year, this money gets invested in for 3 years. In fourth year, this money gets invested for 2 years. And the last year money is invested for 1 year. So the future value of all these would be sum of all these numbers. So we invested 50,000 rupees. That 50,000 at the end of 5 years will become 67,156 rupees. Well, we saw this as future value calculation of 5 years, 10,000 rupees invested at 10% per annum. Now there is an inbuilt Excel function to do this. Equal to FV, rate is 10%, NPR stands for time period, which is 5 in this case, payment is 10,000 every year. We don't have a present value here. So type denotes whether the investment, the payment is done at the end of the period or beginning of the period. So 0 stands for end of the period and 1 is the beginning of the period. And Excel takes as a default option 0, which is assuming it is end of the period. So you will see that if I don't put anything here, it will assume end of the period and our numbers will not match. It will assume that at the end of first year the first payment was done, which is not the case. 10,000 rupees invested today, then at the beginning of second year, then beginning of third year, and so on. So that is why we need to put type as 1, stands for beginning of the period. So now we see that how the same concept is applied on the present value. So we have a question here which is 10,000 rupee invested every year at 10% per annum. What is the value in today's term? Well, we can use the Excel based formula, which is PV, rate is 10%, NPR is 5, stands for the period, payment is 10,000 rupees. We do not have a future value here, and the type is again 1. So if you're looking at this for the first time, this may be overwhelming, but if you try and practice it, you will get better. And above everything, even if you don't want to do this by yourself, and let's say if you hire a financial advisor, you will know what that person is trying to do. So now that we understand the concept of future value, present value, and payment, let's apply these concepts to our retirement analysis example. That is, your current age is 30, you plan to retire at 50, and the life expectancy is 80 years. Let's assume that inflation is 7% and return on your investment is 10% per annum. So as you can see that our earning life is from 30 to 50 and from 50 to 80 is the retirement period. So for simplicity, I have created an Excel for you. If you open up the Excel with the name retirement planning, so this calculation can be done by filling these few numbers and automatically you will get what should be the retirement fund. For example, we understood that your current age is 30, you expect to retire at 50, your expected life is 80 years, your current living expenses are 18 lakhs. So we know that we calculated 5.4 crores in case there is zero inflation and zero growth in your returns. Now we add little bit of inflation, that is 7% we assumed, and we also assume that the rate of return is 10%, and that is in case of both the returns that you earn before retirement as well as after retirement. For simplicity, I'm assuming 10%. So usually once you are into retirement, your returns would be lower because you tend to invest more conservatively. So you need to have 14 crores in order to retire at an age of 50. So we saw that at an age of 30, if you plan to retire at 50 and your expected life is 80 years, current living expenses 18 lakhs per year, you need 14 crores to retire at an age of 50. The number becomes 14 crores due to inflation, because earlier when we were assuming inflation as 0%, the value of this money would have been 5.4 crores. So we assume that inflation is 0% and your returns are 0%. So we see that 5.4 crores was your requirement. However, when the inflation became 7% and your returns that you expect pre and post retirement is 10%, the retirement fund requirement became 14 crores. So from a practical perspective, what is the worth of this 14 crores in today's time? That will be the present value, which is 14 crores divided by 1 plus 10% raised to 20 years. So this gives us the value in today's term. So the worth of this 14 crores is 2 crores in today's time. So now we do little bit of a variation here from your understanding. Oftentimes people want to know at what age they should retire. Let's say your age is 30. Instead of retiring at 50, you are making an assessment whether you can retire at an age of 35. Assuming the living expenses remain as 18 lakhs. So by the time you are 35, your requirement of having a corpus is 6.4 crores. Let's say you already have 3 crores. So the deficit is 3.4 crores. Now you need to reflect whether next 5 years, depending upon your nature of work, will you be able to save that much money or not. If the answer is yes, then you can very well plan to retire at an age of 35. And always bear this thing in mind that retirement planning is also called financial freedom. So at an age of 35, when you are actually retiring, you are attaining a financial freedom. That does not mean that you will be sitting at home. That could actually mean that you do something of your interest, your choice. So you are going out for work, not for money, but for your own psychological aspirations. So do not assume that retirement actually means the retirement of traditional time at an age of 60, sitting at home. So this retirement should be really taken as how quickly can I be financially free so that I do what I love doing. How much to save for your child's future? Remember that child can get a loan for education, but no one gives you a loan for retirement. And that is why child education can very well be a need or a want. A need could be for basic college education in India. A want could be sending your child to a foreign university. So let's open up the Excel with a name called goal planning. This can be used for any goal assessment. We are looking into child's education for now. This requires couple of data points. So first is how much will be the cost of the goal today. So let's say the goal today costs me 20 lakhs. How much money do you have today to fund your goal? Let's say I have 2 lakh rupees. Time required to reach the goal. Let's say your child is 10 years of age and you have 7 years to reach this goal. So at 12% per year kind of return, you need 30,000 rupees per month to save to achieve your goal. Remember that this money, the 20 lakhs of today, will not be 20 lakhs in the future. So because of inflation, this money requirement is increasing to 44 lakhs. So if you save 30,000 rupees per month with 2 lakh rupees that you already have, you will be able to achieve 44.2 lakh rupees in next 7 years. Now we have understood how to apply the concept of present value and future value. The same concept is also applied on understanding how much insurance cover you want to have. Remember that we should never combine insurance and investments together. So insurance should be separate. Insurance name is also derived from the term called assurance. In case something were to happen to you, a sum of money is given to your family that takes care of your family needs in the future. Your potential of income basically defines what kind of insurance cover you need to have. So let's open this Excel file with a name called insurance planning. So there are certain tabs that you need to fill up. Your current age, let's say 30. Your retirement age, 50. How much you're currently insured for, 0. What is the total amount of loans or liabilities? Let's say you have a home loan for 50 lakh rupees. In case something were to happen to you, all the loans have to be paid off. So that's why this money gets added to the insurance cover. Expected inflation, 7%. Annual increase in your income, let's say 10%. Net monthly income, let's say, is 2 lakh rupees. So your requirement is 4.1 crore term insurance plan. So there are 3 things that you need to remember when it comes to insurance. Never combine insurance and investments together. Buy only term plan basis how much is the potential of your income in the future and any liabilities. So this Excel will help you understand that number better. And third is that there is a limit of how much insurance a company would provide you. So that is based on how much income you are making. So usually a ballpark number of 20x of your annual income is what insurance company's underwriting team might be comfortable giving you. For example, if you are earning 10 lakh rupees per year, your insurance cover will be 20x of that. So 2 crores is the maximum that insurance company would allow you to have that. So if you apply for a 3 crore or a 4 crore policy, that will not go through. It will be only maxed out to 20x. And it also depends whether you are a smoker or non-smoker. Depending upon that, the insurance premium requirement will continue to increase if you're a smoker or if you have any health related issues.
I hope you got the big picture right. And in case you struggle with maths, I have given all the Excel sheets, and if you reflect on them, they have each and every formula, so you don't have to spend a lot of time or struggle with those nuances. However, I would still suggest understanding those basic issues of personal finance, such as time value of money in the form of future value, present value, and payment, really pays off well. In case you need any help, we offer a service around this personal finance. You can check out this page, which will give you more information. We provide 1 month hand holding so that you can fix your personal finance issues completely. I hope to connect with you soon. Thank you for watching.